Welcome, everybody, to another episode of the Gold Silver Bitcoin Show. This is actually episode number 100, and we're more than honored to be having back again Mike McGlone, who we've had on in the past. Mr. McGlone, thank you so much for joining us today.
Hey, Justin, I appreciate it. And I find I'm much more easygoing when you call me just Mike, because Mr. McGlone's my father. Thank God he's still alive.
All right, Mike, let's jump right in. We spoke, I guess, approximately a year ago, or maybe a little less.
Yeah.
It's been a wild ride over that 12 months. Everybody's well aware of the headlines, the economic headlines. We're well in the midst of several interest rate hikes. What are you looking at, and can you maybe summarize what has happened over the past year in your view?
Well, I always start out with my outlook, and we can always summarize what's happened. So my outlook for markets, most notably gold, Bitcoin, wherever you want to go with cryptos or wherever we want to go, is I feel with the Fed sledgehammer is what's happening, is pounding out an enduring foundation for gold and Bitcoin. Right now, we're in the pretty much maximum pain stage. To me, that's a forward looking, and I see us heading towards one of the most significant global recessions of our lifetimes. And I don't think that's very profound, and I can dig into why that's the case. The bottom line is we have the Federal Reserve leading interest rate hikes, the most central banks on the planet hiking rates as financial assets deflate and the world tilts towards a recession. And I can give you facts on that in a little bit. So that's essentially a 1929 type scenario. Yes, they're fighting inflation, but all the forward-looking indicators, almost all my forward-looking indicators for inflation are it's going to absolutely collapse and then stay down for a long time, which I think is going to be the environment where I think gold and Bitcoin and long bonds will outperform. Now, I have been wrong this year. They're all down a lot. But to me, that's part of the foundation. The key thing that we can point out today, November 3rd, is NASDAQ's down 33% on the year, and the Fed is increasing its tightening. That's, for the last 40 years, that's been an oxymoron. Every time the market's been down, it's been there to save you. So that is a pretty powerful sledgehammer for all risk assets. Gold is suffering, down about 10% of the year. But I think it's just a matter of time it pops out of this and recovers. And so that's what I'm looking forward to. And as far as what's happened is I look at it as simplistically, this is a way overdue revision in risk assets, most notably stock market. Housing's part of it, on the back of the biggest pump in liquidity in history, and that's dumping. We can look at U.S. money supply, we can global money supply, hiking interest rates. Simplistically, that's what's happening. And I'll end with this, having studied this a lot in my career and just recently read the book Booms and Busts. I forget the author. There's two authors. It's virtually every bust in history has been followed by a boom that was on the back of massive liquidity. And that's what we just did.
The book is, I believe, Boom and Bust, A Global History of Financial Bubbles. David John Turner or William Quinn. Great.
It's a good reminder. Stuff I mostly knew. One thing I really appreciated from that book, I did not realize in the late 18th century there was a big boom in bicycle manufacturing and stocks in England. But it was good to learn that, and then it went bust.
There's a lot of indicators. I saw a fun one about how I guess iPhone had its expectations tempered for their iPhone 14, Apple, and also that Wall Street banks are saying they're just not looking at profiting over the next 2 years. That profiting thing, it worked for quite a while, but we're just not going to concern ourselves with that coming up, which is reflective of this sentiment that you have where we're like in a 1929 scenario. You mentioned deflation, and that's something I wanted to hone in a little bit on. I think maybe it's something that is not understood widely. Do you mean, like, for instance, inflation in the US dollar also?
No, so deflation by an overall value of assets, material prices, most notably from my standpoint, commodities, will resume and at the greater pace than it was before COVID. And to me, that's not profound. I think it's really unusual for people to be expecting the deflationary trends we had for the last 10 years or so to go away. I think they're accelerating, potentially in the back of normal trends, demographics, human innovation, and part of it's the dollar strength. But the key fact is we pumped U.S. money supply up the highest ever on a year-over-year basis, 26% or so. Now we're collapsing. You look at, we have a measure of global money supply, and I watch on the Bloomberg Index since 2004. It is down lowest ever, -5% on a global basis. And so typically what happens in these inflation measures, they measure 12 months. Yeah, sure, inflation makes sense. It pumped up over 12 months. You look at CPI, owner's equivalent, rent, housing. U.S. money supply jumped from the end of 2019 to now or last year about 40%. The Bloomberg Commodity Index is up about 40%. Homes in Miami, property in Illinois, farmland in Illinois, mall exposure all went up about 40%. There you have it. That's going away at the most rapidly, highest velocity ever. Housing is peaked. Interest mortgages are going up. So I see what's happening is the Fed sledgehammer is pounding hard. Now they were behind on transitory. I was initially wrong on that, but now it's going back the other way and it's going to be more enduring. So let's give you an example of what I see from inflation from the world's most significant commodity as we speak right now is $88 a barrel. The first time it traded $88 a barrel was in 2007. That's 15 years ago. And what's the main reason the price is still the same from 15 years ago, despite the fact the world uses more of it? And that is the paradigm shift of the world's most significant demand pull source, importer crude oil, is now an exporter. That's the U.S. and create more of it for a less, lower price. Copper is almost doing the same thing. That's from commodities. It's just these inflation indices that were really on the back of the government throwing money at people, and at the same time, the Fed doing quantitative easing and just pumping tons of money in the system. It's all going away. The problem is when things drop from a higher plateau, that's deflation. So I'll give you an example of deflation and I'll end with this. So last year, crude oil basically went from about 50 to this year's high peak of 130. So it's up over 100%. Now the average price for this year is around 100 and the trading at 88. And it's probably going to go back to 50. Obviously, that's my view. That's deflation from a world's most significant commodity standpoint. And then everything trickles down from there. One of the most recent things that just came out was ISM Manufacturing Prices Paid Index. It's plunged below 50. That's collapsed. The price of lumber was one of the biggest biggest darlings of the commodity rally. It went up almost 300% from the end of 2019. Now it's down. Copper's down. And the key drivers of demand pull on the world basis for commodities the last 10, 20 years has been China. China, is my colleague, emerging market colleague in Bloomberg Intelligence described it, is a collapsing pyramid. Then we have strength in the dollar. Why is the dollar strong? It's tightening. So to me, these predominant deflationary forces that were distorted by the plague and by the massive pump in the system is now going away, but everything is going to drop from a lower, and inflation will be measured from a lower plateau. So the way you look at inflation, CPI is just a measure. It always goes up over time. It fluctuates a little bit. And you measure from the current price from 12 months before, divide by 1. So if you do that and measure from the current price from 120 months below and divide by 1, it goes a little spike and it's starting to turn over significantly. And the Fed's accelerating its tightening. So to me, this is 1929. I asked the question is, where is the global economic growth going to come from? Definitely not Europe. They had that energy spike clearly into a recession. China, good luck with that one. Everybody says when they come out of COVID, they'll be fine, but they have a property crisis and it's a collapsing pyramid. We've been pointing out demand estimate revisions, which have been heading downward for China for almost 5 years. And is it going to come from the U.S.? I'll end with this. Our Bloomberg economics team, led by Anna Wong, they have a model for U.S. recession. Their model is at 100% into 2024 for U.S. recession. So U.S. recession means deflation, means lower prices, and that means one key specific thing like crude oil at about $88 a barrel should drop to 50 or below if we get a U.S. recession, which the model says we will. And the question I ask, what stops that? It's certainly not going to be the Fed. The Fed is hiking rates for a recession at the moment.
On the topic of oil, you've mentioned that you recently tweeted on November 2nd, you wrote gold, Bitcoin, crude oil, energy, and Ayn
Yeah,
Rand, Atlas Shrugged guidance on boosting U.S. petroleum,
yeah.
Texas versus Saudi Arabia, global demand destruction becoming the greater force. Do you have anything to add from, I guess, that note that you had?
Sure. So those of us who've read Ayn Rand, I love that book Atlas Shrugged, where the the parties in power were trying to figure out how to work out in socialism, and that's the way it feels a little bit from the Biden administration. The first thing they did when they came in was restricted the ability for U.S. Crude oil and energy producers to produce energy, drilling, pipelines, and all that. And now they're upset they're not producing energy. It's kind of strange. It's actually funny. And then also what Mr. Biden did probably made one of the biggest mistakes in his political history by going to Saudi Arabia when he could have gone to Texas. The world's most significant producer of crude oil, the biggest producer of crude oil now is now the U.S. If you include Canada, there's a surplus of liquid fuels, which includes biofuels. I'm from a farm. We get 12, almost 13% of our unleaded gas now from ethanol. If you include Canada, there is a surplus probably towards next year, just based on Department of Energy data, of 4 million barrels a day in U.S. and Canada supply versus demand of liquid fuels, includes mostly crude oil. Then you look at China. That fact there was used to be the biggest demand pull source for crude oil. So that's changed. Why? Because of rapidly advancing technology and demographic shifts. The U.S. just jumped onto things like shale and horizontal drilling and fracking and things. You look at China, that's been it's shifted to a big demand pull source for crude oil, but they've peaked their imports of crude oil peaked around 10 million barrels a day, and it's heading lower. Now, people think that's going to go away. It's going to go back because of COVID, and I point out the property crisis is more significant, and China's been peaking for a long time. So what I see happening with energy is what energy did at the beginning of the year in the back of the war was it spiked, and it baited the Fed and virtually every central bank on the planet into increasing their tightening. It increased inflation. But one thing to remember about crude oil is the world's most significant mean reverting commodity. I can point out every single major recession since the 1973 crisis has happened on the back of crude oil spiking, and then it dumps. Last good example is 2008, went to 145, and then it dropped to 40. I see parallels. Now, the price right now is basically is still below the average price from 2008. And what's happening is it's tilting the world towards recession. Major energy crisis in Europe, pretty decent energy crisis here. Now the Biden administration has released a lot of the SPR, add supply to the situation. But what I see is this is walking into a global recession, which means everything will probably go lower in terms of material prices, equities. You should get that enduring deflationary period out of that, which is good for gold, Bitcoin, and long bonds. But the key thing I'll go back to that energy stake is what's notable is U.S. energy production actually peaked in consumption actually peaked in 2005, around there, and actually has been declining over time. That's just efficiency, demographic shifts. Yeah, production's taking off. But that production took off really during the Obama administration, which was not so favorable, but it's just because of the technology. So to me, that's what's coming back. And the only thing that tilted it, to slow it down was prices collapsed. And now the narrative is a lot of people are saying, oh, energy producers aren't going to produce because of ESG and their shareholders only want them to do buybacks and stuff. And I'm like, that ignores the simple rules of Adam Smith and the invisible hand, that I'll end with this. There's a lot of supply, there's a lot of production, and the price on the screen is about double the U.S. cost of production, which is around $40 a barrel.
I'm looking at a headline, BBC News. Bank of England expects UK to fall into longest ever recession. So this parrots what you're saying, or it supports what you're saying. Longest recession in history. We also see that there's this mass homelessness crisis in the United States that has really picked up in the wake of the pandemic, or I think probably the response to the pandemic is more accurate. Homelessness has risen 70% in California's capital and this article takes us inside this, quote, staggering emergency, which entails homeless encampments of hundreds of people, for instance, and also a drug crisis. Now, recession, longest recession in history. It sounds pretty intense. You mentioned 1929, which was followed by mass unemployment and the Great Depression. Do you see similar scenarios playing out? Do you see this homelessness crisis that is gripping U.S. cities, especially on the coasts, getting worse as we head into what the Bank of England's calling the longest recession in history?
I hope not. I don't think we'll see anywhere near that type of unemployment. But the facts I'll point out is the world is clearly tilting towards a recession, and that process is accelerating. We're not seeing anywhere near potential for a trial. Now, the only thing you'll see a trial in that declining growth is, you should see central banks easing well before that happens. But as far as homelessness, it's not really my space. That's horrible. But what I see happening is just the pendulum swung too far, and now it's swinging back, but it's barely started. So that's a pretty broad, significant statement from the Bank of England, and it makes sense, but it's all of Europe. In the U.S., I don't see how we avoid this recession, particularly because every single time we've had a major problem, most notably since the 1987 crash, when the economy is tilted negative, the Fed has been there to save us. I mean, the last few examples, it was just 2018 and 19, the market dropped 20%, boom, right away, the Fed's eased. That's over. That's stopped. That tendency for the Fed to be there and save the economy every single time, and every time the stock market went down, it's gone. But people are just in the early days of figuring out. So just the last 10 years, every single time the S&P 500 dropped 20%, the Fed would ease. That's over. Now they're tightening into a tilt towards recession. So what's going to come with that is unemployment will pick up. I mean, the Fed chairman said it. Pain is the term he uses. It has to be part of it to reduce inflation. The point I'm trying to make is this has been so overdue for a good major reset where we can get back to the old days where in equities where good news is good news and bad news is bad news. In the past, recently, the last 10 years or so, bad news has been oh, great, market's down, Fed's going to ease, got to go buy stocks. Flipping, it's going to just take a little while. So we're going to reset. But the key question I like to ask myself and our audience and you is what stops this process? And what we just saw recently with the Fed increasing its intensification of tightening, despite markets going down, is not something I've seen in my lifetime. So that's the only logical conclusion is we're going to come out of this from a lower plateau, meaning almost all risk assets have to drop to a lower plateau, have to reduce the ability of people to buy stuff, as my colleague Jim Bianco says. And then we'll get to a level we can all reset. But it's not going to stop for a while. And the key issue is Fed's watching a lot of very lagging inflation numbers, and they understand they're lagging. And they're very much trying to lead, but everything's tilting lower. So one of the key things that's left to collapse, and I didn't say fall, is commodities. Let's say a leading thing. So the stock market, S&P 500 is down 20% on the year. Now that's already a good indication of the stock market starting to discount for a recession, but not enough probably because the Fed's still tightening. But the key thing to shoot the drop is our commodities. Now, copper's already done it. It's down 20% on the year, but the sticky one has been crude oil, up 20%. That's part of my lose-lose for crude oil. Yes, I've been early. I've been wrong about crude oil going back to 50, but I don't see what stops it from going to 50 because the fact that crude oil is still elevated is part of the reason the Fed and a lot of central banks are still tightening. Or when it does drop and drop hard to 50, that would be a good forward indicator for deflationary forces so the Fed can lighten up on its tightening before the actual lagging measures of inflation go back to their targets, which is around 2%. I fully expect inflation is going to get down to now 2% and stay there for a real long time.
And that, I believe, is the Fed's goal of 2% inflation, if I'm not mistaken. So
it depends how they measure. They use CPI, I think employment cost index, core inflation. There's a bunch of different, more sophisticated ways they look at it.
Looking at a headline right now that was published today on Zero Hedge, central banks are quietly buying gold at the fastest pace in 55 years. Central banks globally have been accumulating gold reserves at a furious pace, last seen 55 years ago when the US dollar was still backed by gold. Any comments on that?
Yeah, so I enjoyed being on the World Gold Council had their meeting. I think it was Monday. I enjoyed being on that call. Juan Carlos Artigas is just the Gold Council I've always got along with very well. And I do know their bias is to support gold, but they do a good job of pointing out good information. And Turkey is one of the biggest buyers. I guess they couldn't really point out the main suspects. I fully think they are. Who's the main countries in the world who are anti-dollar? China and Russia, who are supporting this war. But the key thing I like to point about that is, yes, it makes sense for them to buy gold, to be responsive buyers on dips. That's what they should do, and lighten up on rallies. That's what gold is. Gold is an enduring store of value, and it's been doing a good job of it this year, most notably in currencies that are collapsing: yen, euro, you name it, Argentine peso. But when you do that, I fully expect we're going to look back at this period from the future and say they should be adding Bitcoin to that space too. Now, that's not profound at all. When I read Saifedean Amis's book, The Bitcoin Standard, about 5 years ago, I think it was, I thought it was silly, but every day that goes by and this Bitcoin thing doesn't die and gets better and stronger and it becomes more significant, it's becoming the digital gold in a world going digital. So my bias is anybody who buys, hoards, or allocates to gold is becoming increasingly at risk if they don't add some Bitcoin to that space. So that's my takeaway. It makes sense that central banks should be buying gold, particularly those ones who hate the dollar. But the key fact of getting over from that to cryptos is the most widely traded crypto on the planet is not Bitcoin or Ethereum, it's the dollar. And this is a thing I've been pointing out for years. This is part of the reason I've been very bullish the dollar versus other fiat currencies, because it's what Churchill says. It's the least worst of all the other currencies, and it's just it's unstoppable at the moment. Cryptos have been a good indicator of that, because the base layer for cryptos has become the dollar. The most widely traded token crypto is Tether. It's controversial, but it is a crypto dollar, and that's the key point I've been making. The world organically decided to go there, but going from the dollar is a great way to transact. You just don't want to hold it over time for long unless you're getting an interest rate. Gold is a great store of value, but it's being replaced by Bitcoin in a world going digital. So you have to have some Bitcoin in that space.
I'm looking at a quote by Michael Gappin, I believe. He's a chief U.S. economist at Bank of America. He told CNBC regarding rate hikes, "We think they hike just to get to the end point. We do think they hike by 75. We think they do open the door to a step down in rate hikes beginning in December." So I believe that means one additional rate, 75 basis point rate hike, and then perhaps stepping down rate hikes beginning in December. Michael Gappin, chief U.S. economist at Bank of America, he continues, "The November meeting isn't really about November. It's about December." And generally speaking, people say that this is tilting bullish for gold. What do you think about Mr. Gappin's statement there?
I think he's pretty much on the key thing. What's going to trigger this from the Fed? It's inflation numbers are so lagging. We need something to break. Now the world is breaking. The dollar, the currencies in other countries are breaking. UK had a breakage problem recently. The yen down 20% is breaking. Europe going into a significant recession is breaking. China plunging is breaking, although you can't really trust their data. The key thing I think that would trigger this, you can get the Fed to stop tightening in one day. And that can happen with, say, the stock market drops 10% in a couple of days, commodities drop 10, maybe 20% in a couple of days, and the Fed will say, okay, we're done. That's a good indication of deflation. We don't have to worry about it. The problem is right now it's happening, it's orderly, but it's happening so slow, and inflation is such a lagging thing. To me, that's part of that pendulum swinging way too far. The Fed's already gone too much, I think. And in a historical case of a pump and then a dump in terms of liquidity and mentality and human nature, and that they're at the stage now, I think they're tightening too much. But they have to stay that course, or the stock market's going to just go up and start rallying again. That's what they need. They need equities go down to reduce the ability to buy stuff. So I think he's right. The key thing I keep thinking about with everybody's trajectory is the Fed's going to get to 5%. Now, right there, now at 4%. And I keep questioning myself what it takes to get there, not to stop getting to go there soon, and that's some kind of drop in markets or something like a Lehman or something like a Nuremberg trials and with Mr. Putin or something like that. Something it's unlikely. The most likely thing is if you just wake up and you can get crude oil to drop towards 50, boom, that'll do it. What that takes, I don't know. It's and even the stock market to drop another 10%. You need more pain, unfortunately, in terms of forward-looking markets. And I look at my screen right now for the December 14th meeting. That's implied right now they're going to hike 50 basis points.
You mentioned Russia. It'll be interesting going into winter. I guess neither of us have really ever seen a major war that, then this being on the European continent, that then went into a winter and would have, I presume, slowed down. And I'm not sure what effect that might have on the headlines during that period, and then what that will look like coming into spring. So I'm not. It'll be interesting to see if the Russia-Ukraine situation, the Ukraine war, continues to, I guess, weigh on people's minds as we head into this winter, the Ukrainian winter being a rather cold one, as it has since March. And I'm sure there was reason it started in March as well. The ice was thawing. And I think that was widely reported. I'm looking at a headline again. Egan von Greyers, he's looking for a 2.5 quadrillion disaster waiting to happen. He says that the financial system in its current form won't survive the coming recession, which the Bank of England has called the um, longest recession in history. Do you think Mr. von Greyers is being a little hyperbolic by saying the present financial system won't survive?
Yeah, and that's kind of, I think that's the good word to describe it. Well, no, we're all going to survive. It's just going to have to go through some pain. But I think this is just a great, I've been calling 2022 the great reversion to 2020. And beginning of the year, people thought I was an idiot for saying that. I still some of that, but it's happening. And it's just a question over to how we come out of it. I don't know. My looking at it is very much likely it's a very enduring period of underperforming asset prices, with the exception of things like gold, Bitcoin, and long bonds, because I sense very enduring deflation. At some point, we need the Fed to probably wimp out, as Mr. Robini says. I love when he says wimp out, and with their sledgehammer. And as far as how the world comes out of it, my bias since the day one of this war was the major significant country to come out ahead is the U.S. And that's, yes, there's a bias, but just look at the facts of the system. Why, how did the U.S. become energy independent, the world's largest exporter of agriculture and grains, and one of the largest exporters of liquefied natural gas, advancing, just typically adopting that technology? And why is the dollar so strong? Because where are you going to go? China? Good luck. It's one of those lessons from the book by Yuval Noah Harari, I think his name is, the 21 Lessons of 21st Century. You don't want to be bullish any country that no one immigrates to. And who in the right mind wants to immigrate to China and Russia until something changes there? So I view this as a great global reset. And the country that's going to just crush it is the U.S., as long as we don't mess it up. And that's just by using pre-existing systems. Discourse. That's the key thing that doesn't exist in the autocratic leadership of Russia and China. They're leading this war. The key thing is that's the major risk thing, as Jamie Dimon pointed out. You look at it. I showed you one binary option, and that is, which is like the best case. Where a year from now we're having a Nuremberg trial in peace, and there's no more hostilities, and everything's about rebuilding. Something like what happened after World War II. The other side is something nuclear, which can be really bad, which is part of the reason, obviously really bad. Part of the reason my main bias from this has been, if for that option, the grains are the place to be: corn, wheat, soybeans, and T-bills, T-bonds with that, and for pricing for that tail risk. Now, obviously, I don't know what's going to happen, but that war is part of the global recession. That's what did not exist in 1929. It's part of the psychology of a world tilting towards recession. And it's the spike in energy that it created. But what it's coming out of that, it's going to really accelerate this process of moving away from fossil fuels, most notably from dicey sources, and towards renewables. And it's very doable. And that's the key thing people always forget. Sometimes is never underestimate human ingenuity, particularly when there's a major necessity, and that's what's happening. So you saw Europe load up really quick with its natural gas. Yeah, that's 1 year. Get their tanks full. Next year it's going to be a bit dicey, but the things that they're doing with portable energy and liquefied natural gas are just part of the short-term fix for the longer-term mix. It's going to mean much more renewables, much more technology replacing fossil fuels. And that's the key thing I'd like to end with is, having done a lot of that in my house, is decentralized solar. I view it as one of the best sources of energy. I did it to my house. You don't have to transport that electricity or that heating oil, that natural gas. Sure, it's still early days, expensive. You can't store as much, but it's one of those things that Kathy Wood points out, that storage is only going to improve.
There's actually a company up the road here that specializes in exactly that, like a self-contained solar generator. Pretty interesting stuff that they're working on there. Now, the energy crisis. So, I mean, you say it's going to be a little dicey this winter. Then the headlines are saying that do you think this winter is going to be bad? Wait till next winter, and that means like real people are going to be hurting. So, do you think that will be the energy crisis will remain contained in Europe over the
Yeah,
next year? And if, go ahead.
I do. I think we saw the extremes this year. Dutch natural gas, I think, went up, was it 15, 20x on a 1-year basis? That's a lot. Most people's energy bills are doubling. And what they're going to do, cut back in consumption. But it's just assuming not Americans, humans are idiots. They're not. They'll innovate around it. And we'll find alternative sources, get past Russia, hook up more LNG, use more renewables, use nuclear. But to me, the worst is over, and it's the key thing I really enjoyed when people met the extremes in June when they were just buying LNG at the highest prices in history. Was people forgot one fact about winters and global warming. Global warming can be a little bit warmer in the summer. It's also a little bit warmer in the winter. That's just been the trend for decades now. Yes, we get a few cold winters once in a while, but the trend in winters is warmer than normal. Just look at the trends over time. Don't even have to measure it, you hear it. So that means less heating demand for natural gas and heating oil, particularly where I was from, really recent last 30 years in the Northeast. Now that's another logistics issue, but the prices will always adjust, and then supply and alternatives will adjust, and that's what's happening. Now that's it's just, but it's also how you measure it and how you listen to it. It's the common person will hear the fear mongering. I just remember in New York Times for about a couple of weeks there in June, July, every single headline article was about the energy crisis in Europe. And I think natural gas in Europe has dropped 50 to 60% since then. So it's a sensationalism sometimes you have to be careful with. And people who trade markets get it. And so I look at the U.S., let's just go back to the facts of U.S. natural gas, which is the world's benchmark. Right now on the screens, it's $6. It's the same price, I think, as 1998, 20 years ago. It peaked in 2005 around 15. It's spiked a few times, and then there's a main reason why it's gone down, and it's the same price as 20 years ago, which is a deflationary thing, and that is more supply versus demand. The U.S. has been able to come up with more supply, more advanced drilling techniques. The entire state of New York is still closed to natural gas production, which could open up. And that's been the key thing is we can't predict inventions in the future, but that's just one key fact of what's happening in that major cleanest fossil fuel. Is the U.S. is the largest exporter of LNG. Now we had a blip in the Freeport issue, but that's coming back. It's just there's so much supply in this country, and it's been incentivized this year by a significant spike in price. It got up to 10. Now it's back near 5. The enduring price the last 5 years been near 4, and I think it's going to probably head that way again. Partly because the key fact is on the screen now the price is 6. The average cost of production in this country is 2, and there's a pretty significant amount of it available. You just have to get it and prices and provide that incentive.
I've seen the coming recession described as a change from wants to needs. People are going to allocate their resources from buying things they want to buying the things they need. Those are the commodities which you study so well and share eloquently with the rest of us your findings, as well as food and perhaps other resources. We see perhaps this trend starting in Silicon Valley. So much of this software is just excessive, and a lot of these teams are just bloated. And so Twitter's set to fire half of its employees tomorrow. That might be an outlier. I wouldn't say that's part of a trend. There's a lot of turmoil at Twitter now, but also Stripe is cutting 14% of its entire workforce. We saw the VCs a couple of months ago, right, to their startup founders, who sometimes tell me funny things like, oh, we're going to start looking at our bottom line, or we're going to start looking at our profit and loss more. And I'm always like, you weren't looking at that before. But
that's a good comment.
That's a different story. And so what is it going to look like in this recession? How can people prepare? How should people prepare for the coming recession?
The key thing I've been saying for a year now, I've been early on this, is don't buy the dip in equities. That's just kind of hang on. You got to wait to think. Typically, markets have to get quite cheap. That is the problem right now. Equities are getting cheap. They're way below that, but they're very well not priced for an enduring recession. Now, people say it's going to be a soft landing. No, Norm Rubini points out this is going to be a real hard one. Just look at the Fed tightening, and we're way overdue for it. So be careful. Always good to be safe and conservative and build up a nest egg. And key things that I think will get that are cheap right now that will probably change, as I view, first of all, the U.S. bond market and gold as pretty much underpriced for a recession, and commodities way overpriced for a recession, particularly in the U.S., because it's going to trickle down from there. Now, for what people should do, I'm a commodity strategist. That's kind of more common sense. But that, to me, is what things are going to be happening in markets. And this great resignation, we're going to look back at this from history as part of the last time that ever happened in our lifetimes. And that was part of this signal. And what sparked that great resignation, don't underestimate what did it. It was just massive money printing. We threw so much money at this economy, and now we're taking it away. We learned the lessons of too much liquidity, which for the rest of our lifetimes, we will always refer back to when it comes time to economy tilting down, people losing jobs, unemployment going up. And we're always going to refer to that. Well, we can't ease rates too much because of what happened the last time we did ease. So the ease of ease from the Federal Reserve is gone forever until things get really bad. And to me, that's the key thing that's changed. That pump priming is gone for an enduring period until the Fed wimps out, and I'm very scared what's going to take for them to wimp out. That's why I say one key way to help them wimp out without making this really difficult for a lot of people is for the commodity market just to drop and follow copper down 20% in the year, do what it did in 2008, drown a lot. So that helps reset everything. If commodities and energy drops a lot, food's not a big part of it. Crude oil is the most significant. It's the most significant commodity in the planet, and it can so cause recessions and then help you out of that recession when it plunges. I remember this happened in the 80s, 86, or dropped low, and most significantly recently in 2008 and 9, when the 2008, the average unleaded gas price peaked at about $4. Everything tilted over, and then it dropped below 2, and it helped people reset. To me, that's what we're going to need. If we don't have that, it's going to be more enduring and more difficult. It means the Federal Reserve is going to just keep tightening. So that's, to me, part of the lose-lose for material prices and commodities, and people don't like to hear that from a commodity guy, but I just point out facts. You don't want to buy the commodities. Buy the producers. Producers can make good money. The fact is, when they make money, they produce more and pressure prices. But as far as actual people, I've seen a lot of people leave, even here, for positions that are less secure, and they'll probably be the ones who suffer, as you point out, some of the tech jobs that are losing. Now, you saw it happen in cryptos. Cryptos are a good leading indicator on the way up, and a great leading indicator on the way down, but they're really showing bottoming, which is a good sign.
I attend city councils, and I kind of stay up to date on municipal stuff. And so at the last city council meeting I attended, there was one announcement by a city councilor. The feds had cut the Meals on Wheels program by, I guess, $15,000 a year in my town, which meant they were going from 7 meals a week to 5 meals a week. Additionally, they had a deal in place for a building for, I believe, like water piping or something, just kind of mundane like that. And the original estimate was $1.2 million they got a couple years ago, and they haven't started building it yet. And the estimates are now up to 1.7 million because of inflation and the rising labor costs. And they are now going to have to, they're like not going to build walls now. They're going to build the building still, but they just aren't going to be able to have walls inside. They're going to build. That's the way they're going to cut the costs, which I guess good for them for at least cutting those costs. But those are just two, I think, telltale signs of what we're seeing. It's already upon us. We've already seen the inflation. I do see this word deflation coming up increasingly. And on the Bitcoin front, so you mentioned that the cryptos are kind of seeming bottomy. I want to say first, I want to ask now, if this great, I guess you mentioned you use the word reset, so we'll just use this big term, the great reset, that's being thrown around. Do you think that these dislocations could be enough for something for Bitcoin to become held by more sovereign states, or to even become a reserve currency like Mr. I guess Amos proposes?
Yeah. So the fact I like to point out about Bitcoin is it's well on its way to becoming global digital collateral in the world going that way. There's declining supply by code, increasing demand and adoption. I don't see that in any other commodity that I can say that about, except maybe some of the metals, gold maybe a little bit. That by definition means the price must go up over time unless something changes. Now, all I see is that demand and adoption increase, and it's still very early days. Every day that trickles down, you see recently had federal accounting standing boards increase the taxes going positive. The U.S. has a major incentive to embrace this technology like we did the internet and not fall behind, partly because it pushes back on China. China's gone the other way. So I think that's happening in slow motion. To me, the whole space is not going to really reach a significant price plateau until you can push a button on Schwab and buy an ETF that tracks an index of cryptos that are physically traded. And that's at some point that's going to happen. The key thing I like to point out about it is what I mentioned earlier. These days of the way I look at it is holding gold or treasury bonds to me now have to have some Bitcoin in that space and some Ethereum too. And the reason I say that is just, first of all, let's talk about performance. Ethereum has been consistently outperforming Bitcoin for about 4 years now, particularly this year. And it made this major shift from proof of work to proof of stake and cut back its energy production during an energy crisis. But the key thing to remember about Ethereum too is it's part of the ecosystem. It's making possible this thing called crypto dollars, which is transforming the world of people how they transmit, transact in currencies. And it's also many other things, but it's the key thing I think people need to remember is the risks of falling behind are greater than not just partially allocating. So a good example I like to use, I used to work in the trading pits in Chicago, and I remember being in the pits in the 80s, futures. And the guys in New York who were trading treasuries would get upset that the futures were driving the treasury market, which used to be a New York dominated market. And I'm like, well, sorry, futures are just a new technology. Boom, it's still proliferating. ETFs, new technology, making financialization of assets much easier and much better. Investing. Cryptos are the same. This blockchain technology does a lot more, but Bitcoin and Ethereum allows you to get a part of this. Bitcoin is the largest decentralized network on the planet. And to me, the greater risk is not having part of it, particularly at a significant discount. It's dropped 70% from its high. So has Ethereum. Yet the price right now, $20,000, is still about 5 times the last low. And Ethereum, $15,000 is still about 10 times the last low. That's what enduring nascent technology bull markets do. They go up a lot. The only time they go down is from a new high, they correct, and then they go back to that trend. That's what I fully expect to happen. But the environment I see is, first of all, if we come out of this, we're back to that day the stock market just goes back to appreciating and never stops, which I was way overdue to stop, then Bitcoin and Ethereum cryptos outperform. My more likely base case is we're going to a period of enduring deflationary recessions and morbid growth and morbid performance in the equity market, which means deflation alternatives. Bitcoin and Ethereum come out ahead in that environment. Most notably Bitcoin, because it's an alternative for, it's a good pair with bonds and gold. And I think it's transitioning from a risk on to a risk off asset. And the thing that Ethereum's doing is just remarkable. You can't, fight it. You got to just join it. And why? I mean, it just hopefully it doesn't, get too expensive and get too silly crazy, but I don't see what stops it. That's the bottom line I look at. I don't see what stops this new technology. And I think it's just a matter of time that U.S. catches up to Europe and Canada and Australia and approves ETFs and embraces the technology. And the key thing they're focusing on is on stable coins. I call them crypto dollars. But if you're in the U.S., what do you get from cryptos? You get votes, you get money, you get jobs, pushes back in China. And it's the most significant technology I've seen ever in a while that really enhances the value of the dollar. It's gone to the dollar as its base layer. In the U.S., if you're a leader or politician, that's just not something you mess up. Now, they're going through this sausage issue of negotiation and legislation, but they're not going to mess it up. And that's been my bias all along. And everything I've seen is quite positive. Bipartisan bills, female. They're all good.
Lots of speculation. This is the end of the Bretton Woods system. I believe Mr. Putin has made statements. Many people have made statements like that. But what you're, I guess, telling me is that the stable coins, the crypto dollars, might actually prolong, I guess, the Bretton Woods.
Oh, sure. Oh, yeah. It's the exact opposite.
Please, that's significant, and it's historical as well.
Yeah. So, well, Mr. Putin is a dying autocratic leader, as we know. He's sick, and he's trying to live in the 19th and 20th century and fighting a 20th century war. And the U.S. are helping Ukrainians, which are the heroes of the world now, enduring and unearned with 21st century technology. Remember Stinger missiles and and what that did to Russia and Afghanistan? Well, we're just using more advanced technology now to help them out. But I think the key thing to remember about what's happening is these are the significant autocratic leaders of the world who need to keep their power. And that's Mr. Z. China is no longer China anymore, it's Mr. Z. Russia is no longer Russia anymore, it's Mr. Putin. And everybody there, most people there get it. That has to change or they're not going to move forward. But they hate the dollar for a reason, because their systems cannot support their own currencies. China's yuan is collapsing. Their system doesn't work. No one in the world wants their currency, and there's no open discourse and open free capital flows to support it. Russia, yeah, the ruble is doing okay now because Russia's the gas station of the world, but in 10 years, we're not going to need them. It's just changing that fast. I mean, the U.S. did it. The biggest customer of OPEC 10 years ago was U.S. Now the U.S. is a competitor. That's just what's happening in the world. And then Russia and China are missing that. And they're missing the fact that we learned with the Soviet Union, this system just does not work. You need the check and balances of, Churchill says, of capitalism and democracy. And you need to have that discourse. There's no way they're going to keep up. They might get lucky in the short term. That's why I'm very afraid Mr. Putin might use something nuclear, because it's just a dying empire. But the fact is, that's where I see the U.S. as the shining star in the world. And everybody in the world who does not want to be under a tyranny gets it. We better cozy up with the U.S. because I mean, look what they've done in Germany and in Japan. I mean, they still have their own countries, and we help liberate them. Yes, very imperfect, but like the lessons from 21 lessons of the 21st century is, do you want to import? Do you want to immigrate to Russia or China? Good luck. Those countries. I just hope they don't get too seriously silly, stupid.
How do you see that playing out in Russia and the Ukraine?
Well, I think right now we're at the point now is I think it's like I mentioned before, it's obviously quite good, but I think Ukraine and its allies, including U.S., get the fact that we're at the state, it can't win too fast because you're pushing the wild animal into a corner. But the amount of technology and amount of intelligence that I think Ukraine is getting help from the U.S. is probably never going to be known, but it just makes sense to me that when you can provide, a lot of wars are won under good intelligence, that it's just showing the difficulty of fighting a 21st century war with that type of system. Now, we've all read and heard about how the supply chain hasn't worked, Russia's weapons hasn't worked, how easy they are to take out. It's basically become a war of mercenaries versus missionaries, and the mercenaries don't want to fight anymore, and the missionaries out of Ukraine who are winning. So the key thing is that hopefully it doesn't go nuclear, but if it just stays in this simple state, hopefully it doesn't end like North and South Korea. It's still a stalemate, but that's worked out okay. So it's just the key underlying thing. I look at it as a macro strategist. Okay, you got to have the key thing I see, if the war continues to stay this type of stage, it's kind of a bid for the grains, but it's overall pushing the world towards recession. And if we can get some kind of quick peace, who knows how that's going to work out, but it's a key uncertainty that I think is really showing up in the price of wheat. The U.S. is still up $9 on the year. That's it. But that shows you what happens with elasticity. I'll get over to commodities in a little bit. This year, this growing year, 22, 23, including South America and U.S., is probably going to be the biggest crop ever. Unless there's poor growing conditions, major bad droughts, the amount of grain and soybeans and corn we're going to see out of South America is going to be massive. Why? price. They're making so much money. So I'll mention this. I'm from the Corn Belt, which was the Rust Belt. It's becoming the Shining Belt. It's really coming back. Why? This war is helping it, because you look in Illinois, where I'm from, the price on corn on the screen is just below 7. Average cost of production is about 4. For the last 5 years, farmers have barely made any money. They're making a killing now. And that's just part of what you saw recently in Caterpillar earnings and ADM earnings. And to me, this is part of the whole system of U.S. crushing Russia and China by simply not messing it up. And the key thing I like to end with is, why does China steal intellectual property? Why weren't they able to vaccinate their population? Because they don't have the system to do it.
South America, Latin America, China's obviously been cozying up to them. I think Russia as well. They were all very quick to congratulate Lula, for instance, on his win in Brazil. I found that noteworthy. It was like a who's who of essentially it was Russia, China, kind of these perceived U.S. foes, or U.S. foes, if you will. What's going on geopolitically in Latin America? What are U.S. and Latin American relations like, and what effect is China having on this?
It's the one I really am exposed to the most from a commodity standpoint is Brazil. The Brazilian real is up about 9% versus the dollar this year. It's virtually the only currency, with the exception of the ruble, that's up. The dollar index is up 18%, depending on which one you look at. Broad dollar index is like 15%. Brazil has the benefit of being one of the first countries to start tightening last year. So the election, I don't know. I mean, we have my colleagues here are much more exposed to it. The bottom line I look from a standpoint is Brazil now produces and exports more soybeans than the U.S. and starting to produce and export a significant amount of corn. And now they have a major incentive to do that. Good prices, strong currency. They're going to really make up, I think, for what happened with Russia. Now, as far as all the politics, it's much more harder. I'm sure you have a lot of guests who can handle that better than me. I just look at it from a commodity standpoint. There's plenty of copper coming out of South America, and they need the money. So, as far as what China's doing, yeah, but most people don't want to cozy up to China too much unless they're similar autocratic leaders who don't value freedom.
I was reading up on Lula's last term, and certainly it was a time when Brazil was part of the BRIC nations. It was seen as a growing country, and if you just do like a cursory glance at their economy under Lula, it was far from a disaster, at least in my cursory overview. Mr. McGlone, Mike, last question. What is the financial outlook for 2023?
So, Justin, I appreciate your politeness. Global recession is my base case. Fed's going to wimp out. An enduring period of morbid performance for equities. Gold, Bitcoin, and long bonds likely to come out ahead. And that's simply extrapolating current trends into the future. The significance is I was early. I was initially wrong, but this is now much more the consensus than it was when I was talking about this a year ago. Don't fight the Fed remains the mantra. And right now it's still don't fight the Fed. So that's my bottom line. I see commodities dropping a lot. Crude oil probably in a 50 handle at some point next year, and Fed funds starting to drop as the recession in the U.S. gets worse.
We've had the honor and privilege of sitting down today with Mike McGlone, commodities strategist at crypto and commodities strategist at Bloomberg. Thank you so much, Mike, for your time today.
Thank you for having me. It's good talking to you. Talk to you later.
Pleasure's all mine, and thank you everyone for listening.